Imagine lending money to a government or a corporation and receiving regular interest payments for your investment. That's the essence of a bond, a fundamental financial instrument where you, the investor, are the lender. The issuer, whether it's a government or a company, promises to pay back the loan on a specific date, known as the maturity date, and sweetens the deal with periodic interest payments, often referred to as coupons. Diving into the bond world, you'll find a variety of bonds tailored to different investment appetites. Government bonds, like U.S. Treasury bonds, are the go-to for low-risk profiles. Municipal bonds fund public projects and might offer tax perks, while corporate bonds can yield more but carry a higher risk. Then there are the more niche types: zero-coupon bonds, which pay no interest but are redeemed at a higher value, and convertible bonds, which can turn into company shares. The bond market operates on a few key principles. Bond prices and interest rates are like a seesaw. When one goes up, the other tends to go down. A bond's credit rating, given by agencies like Standard & Poor's, signals its safety level. And the yield? That's your expected return, which can be looked at through different lenses, such as current yield or yield to maturity. Why consider bonds? They're a source of stable income, often providing regular interest payments. They're seen as safe havens, especially government bonds, which are favored for capital preservation. Bonds can also diversify a portfolio, offering balance when the stock market gets rough. And let's not forget the tax benefits certain bonds can provide, which is a boon for those in higher tax brackets. However, bonds are not without their risks. Interest rate risk can affect your bond's value if rates rise. Credit risk comes into play if the issuer's financial health falters. Inflation can erode the purchasing power of your interest payments, and liquidity risk might make it hard to sell your bond without a discount. In the grand scheme of investment strategies, bonds have their place. Conservative investors might lean heavily on bonds for their stability. A balanced portfolio often mixes bonds with stocks to mitigate risk while still allowing for growth. Even aggressive investors might sprinkle in some bonds to temper their portfolio's volatility. And through laddering, buying bonds with different maturities, you can manage interest rate risk and create a consistent income stream. In conclusion, bonds are a dynamic and essential part of the investment landscape, offering benefits like stable income and risk diversification. Yet, they come with their own set of risks that need to be managed. Whether you're building a conservative, balanced, or aggressive portfolio, understanding bonds is key to crafting a strategy that aligns with your financial objectives.